Hey y'all, happy Thursday. Welcome to another episode of Tech Backstage. My name is Eddie and I'm joined with our guest today, Chris, the CEO and founder of Tatem. How you doing, Chris?
I'm doing great. Thank you so much for having me.
Yeah, dude. Thanks for taking the time to be on the show, and I'm really excited to be talking about what we're going to talk about today. We'll get to the topic in just a second, but definitely really relevant to what's happening in the economy and the industry right now as a whole. But before we dive into that, I'd love to hear a little bit and just let the viewers know a little bit about who you are and your background story. I think it's really interesting, and I think it's definitely really relevant to the topic. So would love to hear just a little bit more about you before we get going on that.
Awesome. Yeah. So I'm Chris. I went to Berkeley. Knew early on I wanted to be a tech founder, and so kind of positioned myself as that seemed like a good place to go up in San Francisco. My first job actually was not in tech, though. I was an investment banker at Barclays. I was covering software companies, internet companies, marketplaces like Uber, and lots of stories from there if we want to go there on what investment banking's like. But
Yeah, of course.
I went into a startup itself. I went to Fair, the online wholesale marketplace. I was a pretty early employee there, I think 90 or 100. Now I think they're like well over 1,200 employees. So that was an incredible experience. Learned so much. Phenomenal team in business there. Afterwards, I started my first company. It was a online marketplace for interior design. We raised venture capital, built a business, built a product. Unfortunately, that one didn't work out. Lots to talk about with today's topic regarding that. And afterwards, I started Tatem, which I am now building with the team. And it really solves a lot of the problems that I think we had at Companion at my first startup. So that's kind of high level overview.
Cool, dude. That's really exciting. Yeah, I was looking at your LinkedIn and I was like, it's like just finance and co-founding or founding, and I was like, okay, all right, we're very direct and to the point here. Like I come from a very different background, so like I very much in high school I used to be like we used to program games into calculators, but we always thought we were going to be musicians. So I kind of took the meandering path to software engineering and then becoming a founder.
I
I was very
also
much
play the drums, Eddie. So,
that. Well, that's yeah. I mean, if you ever want to jam, I got my bass over here in the corner. We can make probably a pretty solid rhythm section, I think.
exactly.
That's awesome, dude. That's great. Cool. So I guess we got a lot to cover here. So maybe we'll just jump straight into the topic because again, really relevant to what's going on in the world today. But today we're talking about how to move fast while keeping burn low. Um, do you want to maybe just fill us in a little bit on the topic and why this is something that's so passionate to you?
Yeah. So I think there's not as many founders who come from investment banking or finance-based backgrounds. A lot of us go into venture capital. So the people who fund startups are very often ex-investment bankers or management consultants. So they think similarly. But to your point on your story of programming games into calculators, most founders are generally software engineers, product managers, and that's like a slightly different career path. I kind of fell into that, becoming a product manager and then, starting my own company. And then, you just learn on the fly and that's what you end up
Right.
spending time on. But as a result, I'm really, really passionate about how teams, especially in the really early days, when you're under 10 employees, under 20 employees, as you're scaling to 50 employees, as you're hitting 100, how these teams should be managing their finances, because it's really the number one reason that these startups fail, right? Startups die by suicide, not murder, is the famous quote.
Yeah.
And, competitors often are a problem, but generally the markets that people are playing in are big enough to at least build a small business. It doesn't mean every business is going to be the next Airbnb.
Right.
But the reason that many startups end up failing actually is mismanaging their finances, because it doesn't give them enough time to build a truly incredible product that customers love. It doesn't give them enough time to iterate and pivot that product, because maybe the first attempt that they had, they learned there's no customer demand there, so they need to build a second product. They run their business as if they know what it's going to be from the day they found it, and they give themselves 18 months or 24 months to build their business, and that's
Right.
not a long time to build. So it's
Yeah.
very near and dear to my heart, because it's an area that I think can help a lot of early stage founders, people who want to be founders, people in tech who are just interested in startups, learning really best practices there, I think.
Yeah, and I so much of that I agree with and I resonate with it. And I think it's so important too, because like you said, to your point, most founders are not investment bankers. I've talked to some investment bankers and some people in PE and VC, and they're very like the way that people like you and people in investment banking look at companies. It's very analytical, right? There's no emotion involved in it. Most it's just, hey, these are the numbers. This is the market size. This is the percentage we're trying to capture. This is the traction that we've had over the last 12 months. This is our burn rate. And you guys just kind of like put your, magic sauce on it and then come out with like some sort of probability on the other side, right?
I mean, one of our managing directors at Barclays, one of them used to say, managing director is like the head of a team, essentially in investment banking. They used to say, we covered tech, and generally analysts at a college or MBA programs, they want to join a group that they're passionate about. Like I love software, so I want to join a software group. And at the end of the day, the MDs would say, it really doesn't matter what these companies make. All they make is EBITDA, or they don't make EBITDA. So you're exactly right. They very unemotional approach to evaluating whether businesses are, good investments or good to represent for an IPO or to sell, which is, what I was working on. So very much focused on the analytics and how to build an incredible business quantitatively.
Right. And so that, juxtaposed against, I think, in my opinion, the ideal founder. The ideal founder is somebody who has identified a problem that they have a unique solution to and that they are passionate about bringing to market, right? Mm-hmm. And so there's a lot of these, that's really more the emotional side, right? Because they're not necessarily concerned with how it looks on paper or EBITDA or anything like that. They're like, look, I got this awesome solution to this problem and I got to get it out there.
And it's so emotional because you have to believe it when everyone is going to tell you that's not a good idea. That
right.
Even if it is an incredible idea, right? Like the amount of times that you're going to get no as an early stage founder are insurmountable, which is why most of my friends in finance work at very high paying, who from investment banking, they're VCs getting paid a lot of money. They're in private equity getting paid a lot of money. They're at big tech companies getting paid a lot of money. They're risk averse generally. The people who are willing to take on the risk and say, I see a future where this is going to solve a problem that I've identified or a problem for other people that I've identified or my own problem in a magical way. And I'm going to build a big business out of that. That's so much emotion. It's passion. It's really something that usually the founders like love, right? Like I love what I'm doing at Tatem. Like it doesn't feel like work. I work 6-7 days a week because it's exciting to me what I'm doing. And I believe in that vision, but there's millions of people who would tell you that what we're building, we shouldn't be, or whatever it would be, just because of the nature of early stage startups.
Yeah, totally. And I think, people like you that are founders, but also have a background in finance, it's kind of like trying to find, like a super senior full stack engineer that can do everything. It's not a combination that's common, which is why, like you see, it's like they just don't exist, right? So it's why this is a topic, especially right now with the economy and the way, we just talking to some of my other friends who are founders, the money's tightening up right now. And
honestly, yeah.
And they're really, I've noticed that they're really starting to shift the VC dollars towards companies that have already proven product market fit, have already proven traction, during COVID and during the pandemic. And I'm interested to hear your opinion on this as well. But in my opinion, money was going just about anywhere. It's like, oh, you got a good idea? Yeah, I'll throw $1 million at it. See what happens.
Anything in crypto, just add a zero to the valuation,
Right. Yeah. So it's like all of a sudden, COVID's happening and there's just a ton of money. And like, I think we're all still kind of like trying to figure out where all that money was coming from. And we're like, doesn't matter, just invest. But now it's really, we're moving back towards, hey, you need to have, the scalable business model vetted. You need to have some product market fit. Hopefully you have some traction in a user base already. And so talking about this is really important right now, because even for companies that have that, like going out and raising that next round, like you really got to be ready for that, if you're a Series A, you got to be ready for that Series B. And if you're a Series B, because you're not, and there's also all this stuff in between too. It's like, well, what if you're Series A and you need to raise a bridge to get to Series B? Like right now is probably not the best time to be needing to raise a bridge. And
definitely not.
Yeah. So I
think
think,
it's coming back to the fundamentals, like you said, right? It's coming back to the idea. I think we lost sight of that in 2021. Everyone's just like, if you're just
yeah,
building tech, you're going to be a multimillionaire and every
yeah,
employee at your company, and you're just going to kill it if you're building anything in software or whatever it has. And then we are reeling that all the way back even further than, pre-pandemic to, does your business generate profit? Like profit,
right.
people forget there's a simple formula. It's just revenue minus cost. So
Mhm.
not only does it generate profit today, it's okay if you're an early stage startup and it doesn't. But does it have the potential to one day generate profit? And you're seeing even the big public tech companies like Uber, like Airbnb, just getting hammered in the markets if they're not profitable, right? You're
Yeah.
seeing 60, 70, 80% declines in these stock prices of these companies that were high flyers in 2021 because they are growing really fast. And then I think there's a look back now where it's like, well, actually that company is losing money every quarter though.
Yeah.
And they've been 15 years in business. Are they ever going to be able to generate profit? And I think that it's in the early days that you build that culture of profitability. You build that cultural of frugality that enables a company like Zoom, which did go public pretty recently, not that, old of a company, but they are profitable because from day
Right.
one, they thought, okay, how are we going to build a business where today, in the early days, we're going to work towards profitability. We're going to work towards having good unit economics, and we're going to scale that way. And I
Yeah.
think that's where, that's the vision for us at Tatem, and that's the vision I'd like to share with other founders as well.
Yeah, and I actually do want to dive into this a little bit more, because I know that you said, when we were talking about this backstage, you were actually saying that you have specific advice for founders. But one question I have for you before we dive into that, because this is something that I think about a lot, and I'm not trying to knock these brands at all, but like Netflix, for example, going out and spending literally billions of dollars, to build out this studio division and do their own, be able to make their own films and stuff like that. I always wonder if that's setting a bad example for, because there's not a lot of companies out there that can go out and spend that kind of money. And I feel like maybe it's setting a bad example for other companies that don't have that much money, because it's kind of like that, just like burn it all to the ground and then we'll make money later. And that's not a sustainable business model for most companies. So I'm interested to hear, with your finance background, like how do you think that affects, how startup founders are thinking? And do you think that has, somewhat of a negative impact on people that, might be starting their first company or are just getting going?
Yeah, I definitely think it does. And I think that that's actually a solid strategy for Netflix, right? Because they're building a
Yeah.
huge barriers to entry. Like it's very hard if I can't go compete with Netflix right now. I can't pay the cast of Stranger Things like for a single minute of content, let
Right.
alone,
Totally.
10 episodes. But it's all at the right stages. And that's where people lost sight in 2021, meaning people forget that Netflix was founded on the side of Reed Hastings' first company, which was a B2B software company. So he was already very wealthy before he founded Netflix. And they were incredibly frugal in the early days. They went through many periods where they thought they were going to go out of business. They were so lean, so scrappy. At one point, I think in the early days, they had to lay off half their staff when they were still under 100 employees. They went one time with their tail between their legs to Blockbuster saying, please buy us because we're running out of money. So people lose sight of what it was like in the early days of these companies when
Right.
Amazon was cutting down doors and making tables out of them because Jeff Bezos was so frugal that he didn't want to build, like pay for an actual table. And they look today when, Amazon paid $1 billion. I saw it recently for the Lord of the Rings
Yeah.
estimated,
Yeah.
TV show. So that's where I think it can get confusing to people who are either just starting their first company or, maybe just aren't in this industry where they see these huge big tech companies spending billions of dollars on things that seem pointless, but they forget that to get to that point, it was years of working out of a garage, like with
Right.
no
Yep.
salaries.
Yeah.
And that's where in 2021 we lost sight, which was, just raise a bunch of money and just start spending like that from day one. Well, that doesn't work, right? You
Right.
didn't build a business that has the profitable underlying fundamentals.
Yeah. No, and I love that. I think that's a great point of view. So, for those that are listening, I think that there's definitely a lot of startup founders that are interested in understanding how they can be more efficient with their money. So I'd love to dive in and focus on, some of your advice, as a two-time founder now, about how people can continue to move fast, they can continue to scale, work on that product market fit and work on scaling the business model without burning through their entire cash reserves. So, interested to hear kind of like, where you think startup founders should actually get started with that.
Yeah. And like I said, I think it all starts with creating a culture of frugality at your startup. So what do I mean by that? Because some people are like, well, just don't pay anything, don't spend on advertising, don't build a sales team, don't even build a product. No. What the number one, according to Peter Thiel, who I think is obviously preeminent thought leader in this space and incredible founder himself, the number one trait that determines whether a startup is going to succeed, that's most correlated, is the founder's salary in the early days. So what does that mean? It means that right away, first recommendation, cap the entire team's salary with your own salary as the founder. So there's two ways to do that. You can either set your salary as the highest at the company. So you could say, I, the CEO, am going to make $100,000. No one at the company makes more than me, the CEO. That's generally, makes sense to them. They're like, okay, like probably not doing more for the business than you are. And that's one way. And that is still better than some things that I see for sure, or a lot of companies in the early days. But the better way is to set your salary at or near zero, right? And a lot of people might be thinking, who are listening, well, I'm not rich, I can't just not pay myself. It doesn't mean you're rich. It means that you're willing to do whatever. It means moving back to my parents' house when I had a beautiful apartment in San Francisco and living for free and not paying myself a salary, which is how we do it. I think I actually pay myself like $500 a month because I need to qualify for health insurance. But what you're signifying to yourself, to your early stage team, to your investors, you're saying, I'm going to do whatever possible to build this business and make it successful. And this is the number one way right away that you can immediately create a culture of frugality, right? Because you're going to then start treating that money in the bank, that's the investor's money or the friends and family money, or literally maybe you invested some of your own money to bootstrap it, as the last amount of money that you may ever have. You're going to take it further. You're going to stretch it further. You're going to be very focused on generating revenue because you're not going to get a salary until the company generates revenue. So right away, I think that's number one. And I have a lot more, but just wanted to see if you have any thoughts on that.
Well, 100% I agree with you. And, we bootstrapped our company from the ground up. And I mean, we're a little bit different because we're a services company but we are in the tech space. But I can tell you that I check the bank account every day and every dollar in that bank account counts. Because there is no backup plan to that. And you have people that you're responsible to, that you have to pay salaries to, you have to pay health insurance. And if you're irresponsible with that money, then, you're going to hit trouble pretty quick. Right. And then, when we did start taking on, we just took on our first small, friends and family round. Something about a friends and family round, something about having your friends' money sitting in your bank account.
Having your mom's 401k money sitting in your company's bank account. Yeah.
It's terrifying. It's absolutely like the scariest thing that's ever happened to me.
Than taking Andreessen Horowitz money and being like, well, if we lose this 10 million, it is what it is. So the best way is, that was number two. So you naturally led there, is invest in your own startup. Not only did I set my salary at zero, not to say that I'm doing all the right things. We make a lot of mistakes, like every startup, but I also put the first $50,000 check into Tatem, which again, I don't have $10 million in my bank account. Like $50,000 is a meaningful amount of money to me, a huge amount of money.
Yeah.
And you're continually putting yourself in a position where you have to win. Right. Yep. And I think that's what it takes in the early days, right? To get from the Netflix that was, had to lay off half their staff, that was begging Blockbuster to acquire them, that did anything possible to succeed. And then when they did succeed with the mail discs, if you guys remember the old Netflix.
Yeah, I do. Yeah.
That business totally down and said, we need to build a whole new business here, which is streaming, or Amazon with the desks, and Apple and, Steve Jobs' parents' garage, whatever it might be. All of these, you have to just break through walls, because it's really hard to build an early stage business. You guys bootstrap, you guys know it doesn't matter what category, whether you're a services business, a tech startup, whether you're in healthcare, consumer retail, it's just incredibly difficult. There's so many competitors. It's very hard to acquire customers. You have to build a product with nothing. And so if you're putting yourself in a position where you're saying to you and your team, we're just going to make it work, right? Like
Yeah.
we don't need to raise another $5 million in the next round. We're going to take the money that we have right now and we're going to build a meaningful business with that. Not only are you building a very great base for that business, you're probably also going to attract the next round of investment, right? Because
Yeah.
who doesn't want to invest in that type of founder and that type of business?
And that's actually that's a great point, because that's one of the first questions that I hear from anybody that's an investor, right? So hey, is your founding team, are they full-time invested in this, or is this a side gig? And
Yep.
I think that's one of the first indicators, just like you said, is like, if you're full-time and you're investing your own money in it, that means you mean business.
The
Like
founder
that.
of jet.com, previously diapers.com, I think. I forget his name, but very famous. They were acquired by Walmart and he kind of led that. And now he's doing something new. He famously, I think, invested some like non-round number in his startup. And I think they were like the investors at the time. I think it was his first startup before any of those. And they were like, well, we're not 100% sure on the investment, but like, why did you invest like $263,000? Like,
Right.
why that number? And he's like, that's all the money that I had. Right. And you can imagine that they definitely invested once they heard that. Right. They're like,
Yeah.
this guy he's going to be a maniac. He's going to do whatever it takes. He's going to be an incredible founder. Now, I'm not saying I didn't invest all of my money. Like that's a risk that, that's a big risk. But it does mean exactly like you said, making yourself a principal. There's this idea in finance of principal, like it's your money essentially in a transaction, or an agent, which is like the investment bank. Like we don't take any risk. Like, it's easy when you don't take any risk to like just try something and then walk away and it's like move on to the next thing. But when you make yourself the actual owner in a way of the outcome, you're going to find yourself doing more. You're going to find scrappier ways to do things. You're going to be able to do more with less, which the next point is keeping your team small.
Right.
People forget that Google was launched with 4 people, unpaid. Microsoft couldn't even afford the Altair that they were building their original basic code for. They couldn't afford, I think it was like $400. They couldn't afford that. So they built it and tested whether it worked or not during the pitch to the company that they were trying to sell it to. They're like, wow, it works. They were more excited than the company because they're like, well, we've never even tried it. People forget that Apple's second product, so after already being successful, was a team of 25 that launched like the Mac 2. This idea in the past 10 years in startups has been like, you need a 100-person team to build a widget that goes into Gmail is like not true, false, right? Like having a super lean team and running it efficiently, again, that's going to give you way more time to discover what's resonating with your customers, with your product, give you the time to iterate. Sometimes it just takes 2 years to build a magical product, right? Companies, more recent ones like Notion, years that they were in private beta, right? Like it took a long time to just build that type of technology. And that's, not even complex compared to if you're building, something deep tech, like autonomous vehicles or something. It takes a long time. It's not something you just, oh, great, 12 months have gone by. We just figured out how to make, fully autonomous vehicles. That takes years. And so keeping the team small, having everyone wear multiple hats, have everyone really grind, because this is the startup that you're focused on, is also incredibly important in combination with the prior, kind of recommendations.
Yeah. And I 100% agree. And there's a book called Working Backwards about the Amazon process. I'm sure you've heard of it, but there's one thing in there that when Jeff Bezos was talking about the early days of Amazon, there was always that saying of work smart or work hard. And Jeff Bezos was basically like, well, you have to work smart and hard.
Yeah, that's a great quote.
And I love that. And, but I think that really goes to the fact that when you start talking about your founding team right now, they have to really be sold on the idea as well. And I think it also is important, this is my humble opinion, of course, that they have, skin in the game and they have a stake in it, because like you said, you're not going to scale up 100 people to build a widget for Gmail. It's going to be a small team. They have to be dedicated to building a quality product. And, like, I'm sure you're probably the same as me, is like, sometimes we don't have a life, you know what I mean? Sometimes we're working on Saturday night, trying to get a new feature out the door that, we thought was going to be done on Friday and it's not. And so you got to find that small team and they got to be passionate. And if they're
to unite them, like for Tatem, like we use our own product from day one when it was like horrible to now when we think it's a pretty magical product for kind of task management. And we're only 5 months into this, right? And that bonds the team. So if you can solve something that your own team can build, I think that's a huge advantage, because your team is going to become passionate about something that you use every day. Now, not everyone has that advantage. Some people are building consumer apps, But what it does mean is use whatever your product is. So I don't
Right.
even think this was one of my recommendations I had, but it's a big one, is dog food in your product is incredibly important. If your
Yeah,
team isn't trying whatever you're building every single day, 7 days a week, 6 days a week, 5 days a week, it's why are you beta testing with actual users, right? Like,
yeah.
you are the team that should be thinking, wow, this really solves one of my problems, or this talking to hundreds of your potential customers if you're not solving your own problem. So I think that's incredibly important. And I think it's also a matter of efficiency. So on the flip point there, I actually think at Tatem, our team has a pretty great work-life balance. I work a lot because I love it, but
Right.
we end Friday at 3 p.m. We have like summer Fridays every day, every Friday. And that's because, again, focusing on what really matters, efficiency, meaning no one does any work from 3 to 7 p.m. on Fridays. Like, even in investment banking, like, I didn't do any work. Like no one, you just sit there and you wait until like it's acceptable to leave, and you do. So
Yeah.
focusing on where you're actually going to get those productivity gains Monday through Thursday, really grinding. Maybe, yeah, you do have to work over the weekend because it's a new release, but it also means just being very efficient, not boiling the ocean. Internally, having a founder or the founding team or whoever's leading your product who's really very much linear in their thinking, that they're creating a linear process that's like, here's where we are, here's where we need to be, here's the 100 things that we need to do. That's going to give efficiency back to the team. You're still going to need to work incredibly hard. You're still going to need to pull long
Right.
nights, or still going to need to work weekends, but you can alleviate some of the view that if I don't work 7 days a week for 3 years straight, my startup's going to fail. And that's like not
Right.
true. Right? It's balances.
Yeah, I agree. And I think also too, like, I mean, as a software engineer, there's, if you don't take breaks, like there's times when like I sit down and look at the code and I just like, I mean, sometimes you can't even read your own code because your brain's just so fried. You know what I mean? So I do think that life balance is really important, even for founders. I mean, I'm the same as you. I'll be answering emails on Saturday night at 11:30, but that's because that's my personality. But that doesn't mean that I don't disconnect. And if you don't disconnect, you're going to run the risk of burning yourself out. And I think that also is something that you have to take into consideration, is that you have to kind of know when it's like, let off the gas and like just, go for a run, or, go to the beach for a couple days, or just do something. I mean, because otherwise, you're going to kind of run yourself into the ground. I mean, that's been my experience as a founder, is that, and I kind of know when it's time now, because like, I'll just be sitting there and like, I'll just kind of like you said about Friday afternoon, I'll just be sitting there. It's like, Monday morning, and I'm like staring at my computer screen. I'm like, I probably went a little bit too hard in the paint the last couple of weeks, huh?
Yeah,
Yeah.
exactly.
Yeah.
Totally agree. And I think that, another big one that people just forget is referencing some of those companies that I gave examples: Apple, Google, Nike. Phil Knight, he bootstrapped the company as an accountant, which is a brutal job, especially then, because accountants were, I think, more akin to investment banking a little bit. Investment banking wasn't really a career. So I'm sure he was pulling long nights.
Right.
He definitely was, like weekends, like working. And he did that for years, paying Nike's bills. So I think, again, it's a lot of this coming back to the idea of just people have forgotten like what it really takes in the 2021 era of, you can just say you're building anything and someone is going to give you $5 million to build it, of like what it takes to go from that stage in the early days to then a successful growing business in the second, third, fourth year. And it is a mix of grinding, working hard, working smart, being incredibly lean, but also, like you're saying on this most recent point, making sure that you think that this is a marathon, right? Because it's not going to be a year of doing this. It's not going to be a year and a half. It's a 10-year journey. It's a 7-year journey. It's a 15-year journey sometimes to do it. And you have to be ready to kind of build at that pace. And that means you need to make sure you're taking care of yourself, making sure the team is taking care of themselves, making sure you find hobbies a little bit outside of work, I think are very important.
Yeah, no, I 100% agree with you. We got a couple minutes left here. We blew right past the wrap up period because this is such a great topic, but just kind of interested to hear, kind of final closing thoughts from you about, just any last words of wisdom for any founders, or, anybody that's looking to maybe start a company that's listening in today.
Yeah, I think the last piece there is build lean in general, right? It means thinking about that approach of how can we give ourselves as much time as possible to really validate whether what we're building has success. And that's when you then pour on the money. We kind of touched on it and we got sidetracked to Netflix. There is a time when you should be spending millions of dollars a month, probably in like a growth stage. But that's because you've already built the fundamentals where the business works. And now you're just trying to grow as fast as possible and then come back towards profitability. But to get to that point, it's all about building very, very lean. And there's a reason that the best startups that all of us are thinking about, they were all built during recessions, right? Yep. Airbnb, Uber, PayPal, etc. These were all built either during or right before a huge recession took place. And there's a reason those became preeminent businesses and businesses that we look to as huge successes is because they had to build this culture in to succeed at all. They would have just died off if they ran like the companies are in 2021. And that's today too, right? So there's a huge advantage, in my opinion, actually, to building right now. There's less competitors because less people are getting funded than ever before. You have the opportunity to actually take a little bit slower, build an incredible product. The best thing that you can do in the early days of any startup is just building a truly magical product. You can't hack it. You can't find a way to create a product that is magical. It just takes time. And it takes a lot of, iteration and kind of talking to customers, continually getting feedback and iterating. So I think that's the biggest piece of advice there.
Yeah, I agree. Well, Chris, we're out of time, but thanks so much for taking the time to join us. I think it's been a really valuable conversation. Definitely a topic that I'm passionate about, but I know that it's definitely a topic that, hopefully will help some of the listeners. So I appreciate you taking the time. And Carlos, do you want to pop in and talk about the last show that we have on the week?
Certainly, Eddie. Thank you. Appreciate it. So tomorrow, there's only one more show for the week, folks, and that will be with Anand Deravian. Anand is the product management and strategy and innovation at Airs. So please join us tomorrow right here on Tech Backstage at 11 o'clock in the morning Pacific time. Remember, show up and have fun. And during the weekend, be safe, everyone. Thank you so much.
Thanks, Carlos, and thanks, Chris, again. We'll see you soon.